Welcome back to Ground Floor Market Trends. I'm here with my colleagues Jeff Seal and Albert Francois, a great name. Jeff is our head of sales. Albert is running our new product, the DSCR product. And that is what we're here to talk about today. So Jeff, go ahead and introduce yourself to the Ground Floor Market Trends audience.
Jeff Seal, Vice President of Originations here at Ground Floor. I've been here for, 4 or so years as head of sales, and primarily focused on the RTL side, but have been lucky enough and fortunate enough to start to expand in this DSCR space.
Excellent. And Albert, you're a newer addition to the Ground Floor family. Why don't you tell us about yourself?
So my name is Albert Francois. I was brought in to Ground Floor to help push the DSCR initiative. I'm the Associate Director of Institutional Loans here. So the goal is just to see what we can do on the DSCR and add a complement to the bridge that Ground Floor already does.
And Jeff used a fancy word on us all. RTL stands for Retail Transition Loan. That is understood on an everyday basis as the fix and flip loan, right? So that's a core product that Ground Floor offers. We offer new construction loans, fix and flip loans, the RTL space, bridge loans, and then now we are offering the DSCR loan. One distinction about the DSCR loan, which is unique in our offerings, is that this is not funded by, our 80,000 investors in our crowd. This is funded by an institutional partner. So Albert, why don't you walk us through the institutional side of this business and what we experience sort of differently with them versus our crowd.
Yeah. So what I usually tell clients is Ground Floor can get things done pretty fast because they have their own money. But when it comes to the DSCR product, some people call it the long-term, the rental loans, they have what we call institutional backings. Those are usually private equities, hedge funds, insurance companies that are basically buying or funding these notes, the DSCR notes. Again, we got to keep in mind, these are long-term products, 30 years, 15 years, 40 years, compared to a 12-month, 24-month product. So the institutional side is really what we call the investor, the person that's dictating the guidelines, the credit box we have to follow, and things that the criteria that the loan needs to meet for them to accept the note.
Excellent. And Jeff, what does actually DSCR stand for, and what problem are we solving for our clients with this loan?
Fantastic question. I'm glad you didn't go into too much more detail on the DSCR side, but I can answer that one. Debt service coverage ratio would be what DSCR stands for. But no, it does serve a pretty significant need for us, even though that the capital is very, very different. One thing we've done a great job of at Ground Floor is providing these short-term fix and flip loans over the last 11 years. And the other thing we've done a really good job of is turning any client who needs any long-term options away. And so that has always been something, and we've always had because of where the capital came from, we've struggled with trying to figure out a way to, through our current capital sources, service those long-term requests. And so this allows us to give those borrowers who have rental disposition strategies an opportunity to continue to work with the team that they've always come to know and love, and continue to get them to the end game without having to go out and search for a product that our competitors are offering. So very excited. Yeah.
So Albert, so when we're looking at product differences, you mentioned one key one, and that is duration. So this is a 30-year loan, right? A Ground Floor RTL or fix and flip loans, typically 12 months, right? So what differences in rates are there for borrowers on the DSCR side versus the RTL side?
Oh, it's a big difference. So typically on the RTL bridge side, these are construction loans, fix and flips. The rates are between 10 to 11.5%. When it comes to DSCR loans, you're halfway there. Rates are usually right now in this market within that 6% range. Again, keep in mind, it's long-term. So payments are being made out through 30 years, right? So you're at the 6% range. I want to say right now the market's hovering around that 6.5, 6.75 range. So that's the difference between the bridge side, RTL side, and the DSCR side.
So when I'm looking at this, when I'm looking at a DSCR loan, the duration is permanent financing on this property, essentially,
Yes, sir.
versus transitional bridge financing that we do typically in the core.
You got it.
Yes, sir.
Amazing. All right. So when we're thinking about reasons to offer this loan on our platform, what comes to my mind is that over the course of the last 3 or 4 years, there has been a marked change in how loan repayments are made, right?
Mhm.
4 years ago, 3 years ago, even, we had about a 60 to 70% repayment from sale of property, right? Given our current, market where sellers are really holding on to properties, right? And there's this lock-in effect. We are now seeing a higher degree of repayments coming from refinances. And we've seen that increase year over year over year. So how does this product, Jeff, help and give liquidity to our current borrowers
Mhm.
that are looking for exit financing?
Yeah, no, it certainly does. It actually serves our investors very well. I would have to say but it does. It gives upon completion of that fix and flip scenario. There's no need to continue to source their long-term solutions with a local bank who may have a heavier financial underwrite for that borrower or source from one of our current competitors. It gives them the opportunity to turn right back around to the exact same people that they've been talking to for the last year to service their RTL to get their long-term solution put in place. What's nice about this is there's certain controls that it gives us as well. We have insight into the exit. We can help facilitate that exit. And so for a company who is also trying to serve a group of investors and from a payoff perspective, they want to see that transaction as well. And having more insight into that transaction is supremely beneficial for the investor side.
So the word that I like to think of is exit liquidity, right? The exit liquidity is coming from the institutional finance partner that we've established, right, Bert?
Mhm. Yes,
And
sir.
that exit liquidity picture has changed over the time, and this is our response to the market to provide borrowers with exit liquidity if they are holding the property, and they no longer have to go out and search for some other provider of capital. They can find it right here at Groundfloor.
Mhm.
So Albert, how has the reaction to this product been, with the customers that you've talked to and the customers that you're attracting to the Groundfloor platform?
Oh, to be fair, the conversation has been great. And like Jeff mentioned, a lot of these investors, borrowers, brokers, they don't want to deal with 5 lenders, 6 lenders. They want to stay with one person that can do everything. They have a relationship with the people at Groundfloor. They love the service here. Now that they know that their exit strategy is I can stay within Groundfloor and do a long-term loan, the conversation has been great. And they've been saying it's about time. You guys should have had this. I hate the fact that I have to go somewhere else and reintroduce a relationship. So having the DSCR aspect in Groundfloor is it's probably the best thing our clients can have, and that keeps them in-house and it's revolving, so it feeds itself. It's a great concept.
So Albert, Thanksgiving's ahead of us next week.
Mhm.
What I'm thankful for is that we have now, the talent and resource for the borrowers and our salespeople and the brokers that we service to call you and get the data that they need as to where the market is relative to leverage for this product, where the market is relative to rate, and they don't have to go any further than our platform. And so, are you thankful, sir, that now have a book of business that we've developed over the last 10 years, a portfolio of $300 million with repayments coming in every month that you can help those investors who are not selling those properties, but holding on to those properties, give them, a proper exit?
Yeah, yes, I'm very thankful for that. And I'll say this, during my interview process with Groundfloor, when Jeff and some of the executive explained how Groundfloor is structured, it's like the light bulb in my head went off, and I was like, wow, this is going to be so great feeding into the DSCR product, just the way they do business on the bridge side and how they've been sustaining themselves for 10 years, even when the market was a little shaky in the past couple of years. Yeah, I'm very thankful for the way Groundfloor has established itself in the past couple of years, and now transitioning and or adding this new product is gonna feel seamless and it's gonna flow. So I think that's a great thing.
One of the things that attracted me about the concept of Groundfloor, I'm a dinosaur. I've been here going on 9 years. I was the 6th employee, right? So certainly seen this grow, but that borrowers, right, of our capital, and the investors that are investing the capital into these projects, they have this ecosystem, right? And, this is another step in helping that ecosystem really function well in all market environments, right? So we have the borrowers using our capital to improve properties, which improves neighborhoods, which improves their cash flow, which improves their balance sheet when they take a property on and then eventually sell it. And now we have an in-house, essentially, even though we have an investor partner taking these loans on, we have in-house exit for this platform, which just is going to help the investors who have invested their capital realize their returns, in a duration that they expect, right? That there's the liquidity is there for the exit. Our sales team is now able to provide our borrowers, that exit. Jeff, what does that mean to you as the head of sales?
Oh my God. Yeah. It's hugely beneficial, right? It's anytime you get a complementary product to tack on top of your current product, that's a really, really good thing, right? We're always, as head of sales, I'm always just looking to do more, right? More transactions, the better. And so this just having the opportunity to transact really with little to no marketing efforts, right? We're servicing the same group of borrowers we've serviced for 11 years, and that's what's beautiful about it. We've just added another product that we can monetize, and so it's very much a win-win.
So Albert, how does a prospective borrower that is listening to this podcast, ask for you? How do they get in touch with you? What is the best way to reach Albert and talk about prospective financing for a property that they own and want to put some permanent debt capital on? You're on mute.
Can you guys hear me?
Yeah, now we can.
Sorry about that. Like I said, I'm available everywhere on social and platforms, but also if you go on the Groundfloor website, you just click DSCR. Typically, there's a get started intake. Once you fill that in, the team gets the notification. Either I or somebody from the team will reach out. If you want to reach out to me personally, I'll give you my email, which is bert.francois @groundfloorus.
And we'll have that.
Or
yep.
Yeah, or they can just, if they get a chance, they could schedule a call with me. We're available. The team is ready to service them. We have our processors, our underwriters. Everybody's available to just talk about DSCR.
And when a prospective borrower is thinking through this type of financing, what are some of the documents that they might need for this? Would it be bank statements and leases? What are the documents that are required?
So yes, that's actually a good thing about DSCR. The qualifications and the document requirements are minimal. Typically, we need, I want to say, about 8 to 9 steps. An ID. We need an appraisal. We need title, insurance, the common stuff. And I would say if they have a lease in place, we want to see that. If it's a purchase, we want to see a purchase contract. Just the basic stuff to get any real estate deal done. And when it comes to assets, we only want to see 2 months bank statements. Remember, the focus of a DSCR loan is the fact that the property itself is generating that cash flow, right? It's covering its own debt. That's the whole purpose of it. So there's not much requirements on DSCR and compared to a conventional loan.
And you're obviously very happy to help them through that process, to help them get done. And how long does it take essentially to close this type of a deal?
I usually tell all my brokers and borrowers it typically takes about 21 to 30 days. And the reason why is because we need to get an appraisal. Typically, the appraisal takes about a week and a half. If we can bypass the appraisal, and have the client provide these tips to us, we can close a deal within, I want to say, 3 weeks, 4 weeks, in the best case.
So they call you. They have a preliminary understanding of sort of what docs they'll need to gather. They call you. They submit an application, submit a lease and a bank statement if necessary, and then we're going to do an appraisal, right?
So
We'll get the underwriting approval, and then we'll go to closing. No big deal at all.
I usually say 5 steps to get a DSCR deal. You get a quote, you'll review the quote, you sign it, you provide the documents, it goes to underwriting, and then we close.
And then
very simple.
And then the ground floor investors get repaid. Amazing.
And then everybody gets repaid.
The
Yes.
circle of life is complete, Mr. Seal.
There it is. Yeah.
Jeff, when you're thinking through the growth of this potential product, what do you see? What do you see for this launch?
Yeah, I mean that's what's so exciting about it, right? It's it is a product that everybody is aware of, or at least in our space, and it is in need of. Most of the people in our space, most of our competitors, do a fair amount of DSCR. I'd say more than half of their book actually is DSCR. And so when I look at the business, we currently do, that's exciting enough. And to think that we could easily double that in the first part of next year, it's hard not to get excited about that, right? And that's, yeah, so it's going to be extremely impactful for Groundfloor in 2025. Now that we've spent the appropriate amount of time to build the necessary back office stuff in order to process the stuff efficiently, now it's time to start pushing things in there. And so we're just now starting to see that growth that we are excited about for 2025 hit the inbox.
Absolutely, and I'm excited to see it, guys. And whatever I can do to help, I'm happy to help. From a market perspective, we are talking to the ground floor market trends audience.
Mm-hmm.
From a market perspective, I have this to offer. Likely, barring any sort of geopolitical issues, we should see a gradual rate decline through 2025.
Yeah, agreed.
Which is going to make rental properties that much more attractive.
Mm-hmm.
Right? So we should see a good growth trajectory for this type of financing and the need of it. Now we also know, since we have an institutional partner willing to take this debt, that the capital markets are more than willing to offer money for this product. There is an abundance of capital for this product.
Mm.
Exit liquidity for our fix and flip loans, for our new construction loans is there. We offer it now. It's amazing what you guys have stood up in such a short time. And the market is going to be, in my estimation, supportive of this type of product, definitely for the foreseeable future. So good luck to you, gentlemen. It's been great here to talk to you. This has been episode 10 of Ground Floor Market Trends. I want to thank you for listening. Happy investing. And gentlemen, I'll see you on the other side.
Thank you.